Good evening. What would be some recommendations to buy physical metals, example gold and silver? I'll get into a discussion of that shortly. And I'll tell you why I have the perspective that I have on it, which is probably different than most financial advisors. Let's see what we got here. We're 6:34. Okay. So let's kind of get things started. I know it's 6:34. I said we'd kick things off at 6:35, but we'll kick off a minute earlier. I want to thank all of you for coming this evening. Tonight's presentation is Investing in a Volatile Market. My name is Mark Lange, and I've done a couple of presentations in the past. So for those of you who are familiar with me, I will try not to feed you with the fire hose tonight as I usually do, but it is just kind of the way that I do things. So without further ado, let's get started. So I want to thank all of you for taking some time out of your busy schedules to chat about investing in a fragile market. So let's talk about some of the common elements, what I call common repetitive investor scenarios. When the market's down, prices have dropped, the number of shares generally remains the same unless you're continuing to add dollars to them by doing dollar cost averaging or you're doing some reinvestment of capital gains and dividends. So these are just common elements that are occurring on an ongoing basis. Now, many people will say, well, gee, I've lost X number of dollars. Well, you haven't lost any dollars unless you've acted upon your account, meaning you've actually sold something out. So unless you've sold something out, it's down in value. This is not uncommon for the market. And these corrections and bear markets occur on a regular basis. The biggest problem that I find with most people is that they believe that these are unusual. They're not unusual. They happen every single year. And in most instances, they happen multiple times in the course of a year. Okay? So I look at investing from two fundamental standpoints. First one is accumulation, and the second one is what? The distribution phase. They're two totally different objectives. And if you manage your money the same way in both environments, you may find that in the second one, during the distribution phase, it's very uncomfortable for you. So if this is something that you have not explored ahead of time, it's something that I would tell you to do. Because one of the key things that I always talk about, especially when we talk about investment planning, and especially for those that are closing in on retirement, are two key elements. One is called the sequence of returns, and the other one is called the high risk corridor. And I'll talk a little bit about that later. Additionally, when you switch, move, or reallocate in your portfolios, again, you're acting. So you're going to sell something to buy something else. It is not uncommon, especially for those of you that use a very systematic approach, to go in and reallocate dollars from one investment to another, sometimes when they're up, sometimes when they're down. So if you use that systematic approach, you're going to be quite familiar with seeing some of your investment vehicles being up and some of your investment vehicles being down. It's very important for people to understand that the market is this constant fluxy type element. It never stays still. The other thing that markets never do is they never just look at what's happening today. Where are they looking? They're looking 6 to 12 months out. What are they looking to anticipate as a result of the things that are happening today? So it's very important to understand those. So let me talk about some of the rules of the game. And when I talk about the rules of the game, ultimately, when we get to the end, income is what we earn, but it's not what we keep because we have someone who's a partner in all the income that we earn, and that's the federal government. The wealth is what you ultimately get to keep out of that. Taxes are what Uncle Sam happens to take away from you. And debt keeps us from the opportunities of wealth accumulation in many instances. Why? Because our economy's been built on what? A credit-based economy. We're not a savings-based economy. If you went back to the early 1900s, We were much more of a savings-based economy and much less of a debt-based or loaning type of an economy. And then lastly, our behavior towards our finances creates the habits that either put us in or out of the game. And I say this consistently to people. Very few people, when we get into planning for investments, and especially get into a market like this, when I ask them, what is your game plan? They look at me, they shrug their shoulders, and they have no idea what I'm talking about. So one of the things I was talking about to our librarian assistant before we got started tonight is when I typically meet with my clients in the beginning of the year, I discuss things the same way that I discussed the old movie called The Good, the Bad, and the Ugly. So I want to talk to my clients about, hey, what would be the good things that would happen over this next year for you, and what will you do as a result of that? What are the bad things that could happen to you over the next year? What are they, and what would the implications of those things be? And then lastly, what's the ugly component? And when I say the ugly component, what would happen if the market goes against you? What are the changes that you're going to make? I would prefer that you decide what those changes are going to be before you ever get into a market like that. Why? Because now you've used your head to make the decisions, not your heart and what the market's pulling you in one direction or the other to do. So please think about your investment game plan from that standpoint, the good, the bad, and the ugly. It will really help you to solidify the decisions that you're going to make during difficult periods of time. If you don't do that, you're going to be left to the whims of the marketplace, and I don't want to see you do that. So ultimately, we want to increase our wealth through accumulation. That's why I divide money management into two fundamental categories, the accumulation phase and the distribution phase. We try to reduce taxes as much as we can and hopefully stay ahead of inflation. We can control a little bit of the first one, but the second one is very difficult for us as individuals to control. Third, we like to utilize diversification to lower risk and enhance returns. That's why in many instances, rather than buying individual stocks as positions in a client's portfolio, many of you will use what we call managed products. What does that mean? You're either going to purchase an open-ended mutual fund, an exchange-traded fund, or a closed-end fund. Some of you may also use some private money managers. But those elements across the board are being used to do what? Diversify your portfolio and decrease the overall amount of risk. You've got to have a game plan for investing. I can't tell you how many times I've had people come into my office, been referred from another client. I'll sit down and I'll say, why do you own this particular piece? And I get this, the shoulders shrug. If you don't know why you own something in your portfolio, why would you put the money that you worked so hard into those investments and not have any idea why you put it in there? Very important to understand that. If you're not sitting down with your advisor or individually and asking yourself those questions, how do you know what your portfolio is designed to do? And then lastly, developing enough money so that you can live the type of lifestyle that you want with the options that you want, especially as you get out into the retirement period. Why? That's what we call financial independence, when you have enough money to be able to live the lifestyle that you want to live. So let's talk a little bit about, as I like to say, the game. So the time frame, basically we divide into three distinct categories: short term, midterm, and long term. Well, if you're somebody that's looking to save or spend some money towards a home today, and you've got it sitting in a short term investment vehicle, do you want it sitting in the market with what's just happened over the last month and a half? No. So think about the types of investments that you have and what they're designed to do. If you're looking to purchase a home anytime close to now, why would you want to put your assets into something that's extremely volatile, that you have a high probability that you could lose based upon a short-term basis? Wrong place to be invested. So think about what your objectives are for the dollars that you have and make sure that you choose the appropriate time frame. Tax consequences. For most of you, when we talk about tax consequences, we're really talking about what we call non-qualified or non-taxable accounts. What does that mean? Those are the accounts that don't have some sort of a built-in tax advantage. So, for example, when we talk about IRAs, 403Bs, 401Ks, 457s, things like that, those are all what? They're internal revenue code sections that provide those particular types of plans with what? Some tax advantages. So, for example, if you contribute to an IRA, for most of you, if you think about it from a traditional standpoint, you put money in, it reduces the income that you earned for the year. So you reduce the amount of taxable income that you had, and those dollars can sit there tax deferred until you actually go to take them out. Same thing can occur with a 401k, 403b, and 457. Those are all internal revenue code sections that give you some significant and distinct advantages. Next thing that's important for you to do is to utilize diversification / asset allocation. Why? Because we know that having a diversified portfolio over a long period of time does two things. One, it reduces the overall risk of the portfolio, and it also enhances the amount of returns that you can potentially get. But if you're not familiar with how this works, I'd encourage you to sit down with someone who can take you through this educational process so that you get a deeper understanding of what it is and how it works. Next up, liquidity. And I always tell people it's important to have some liquid funds available to you at all times. Why? Because there are times that emergencies occur in life, and it's very important to make sure that you've got dollars available so that you don't destroy the integrity in other places. I'll give you a perfect example. Many, many years ago, when I first started in my career, I had a number of very good friends who worked for the Home Depot. This is in the early stages when the Home Depot was growing from a very, very small organization into a mid-sized organization. Well, many of them who had been with the Home Depot for a few years had gotten employee stock options. So sometimes when they were in a bind, if they had to purchase a new vehicle or what have you, they would have to actually cash in some of those stock options. Well, I had an individual that did that. And I stayed in touch with him for quite a number of years afterwards, and those stock options split, so forth and so on. So the original truck that he purchased for about $35,000 by liquidating those stock options, ultimately, in the end, had he not touched those stock options and had dollars available to purchase the vehicle, he would not have missed out on almost $500,000 worth of stock options. But because he needed a truck, he liquidated them long before he should have. And instead of getting a $500,000 return, he got a $35,000 truck out of it. So important to pay attention and think of these things beforehand. Ability to have a long-term perspective. I can't tell you how many times people say I have a long-term perspective until they see the market do what it's doing recently, and all of a sudden they get into the panic mode. Sometimes people will say to me, you don't seem to get into a panic mode. Well, this is my 47th year in this industry. So after a while, I've been through a number of these, and I actually look for certain things during periods like this because I know everyone else is very upset, and they're typically inclined to do what? Sell things when they probably shouldn't be. I would like to purchase those things, especially if I think that they're good values. Not becoming sentimental, holding on too long. The big three investment tenets. Well, we obviously would love to buy low and sell high and hold when in doubt. But here's the other thing that's important, that's a little bit of a misnomer about this kind of a statement. In many instances, we want to hold on to things that we've owned for a long period of time, especially if we're talking about estate planning. Why? Because we want to get what's called a step up in basis, meaning, let's say that dad or mom purchased, for example, Verizon, and they did it many, many years ago when it was $10 a share. Well, today it's $42, $43 a share. If they were to pass away and pass those assets on to heirs, they would get what's called a step up in basis. So instead of the $10 purchase price being retained, it would now get a step up in the cost basis to the date of death valuation, which if it occurred today, would be $42 a share. So if they turn around and sold it tomorrow, would they have any gain? No. They own the stock at 42. It sells at 42. No taxable implications. But more than anything, the last part is very important. Having a game plan that fits you, not your friends, you. What is it designed to do for you? I can't tell you how many times people say, yeah, but my friends are doing X, Y, and Z. And I go, so do you have the same exact situation as your friends? And in many instances, they don't. Yet they want to do exactly what their friends are doing, whether or not it's good or bad. Here's a couple of facts. Okay. Market declines happen. I love this one. There have been a number of bear markets over the last 30 years. There's been quite a few of them, actually. If you go back, we had 2008, which was a wonderfully difficult bear market. You had a very short bear market with the COVID situation, the crash of 1987, and a couple other ones along the way. So if you're in accumulation mode, is this a bad thing or a good thing? Well, if you're in accumulation mode, it's probably the best thing that could possibly happen to you. Why? Because you're going to get an opportunity to buy things at a deep discount compared to what their intrinsic value is in many instances. So if you see that happen, and there's particular companies that you like and you think that they're going to perform well, or sectors of the market, now might be a time to start to step in. I certainly don't advocate taking every dime and dollar that you have and throwing it into the market. Nobody knows exactly when the market's going to be at the top or the bottom. But if you've had a very significant pullback and you're looking to build into positions, now is a wonderful time to take advantage of that. If you're on the other side of that equation and you're in the distribution planning phase, there's a bunch of different elements that you're going to have to factor into that equation. So this is one of my favorite slides, this one and the next one, because this is the S&P 500, and you can see, this is going back to 1980, the average annual maximum drawdown was almost 14% a year. Let me repeat that, because there's a whole bunch of people that think that these types of events and these types of occurrences are unusual. They are not unusual. Look at this chart. These things happen all the time. Please control your emotions. These are not unusual. What is unusual? The variables are always a little bit different in one market downturn to the next. But it's amazing how many times we see a rhyme in how these things occur. So this gives you a little bit more of an idea. This is a JP Morgan piece. And this one is the most up to date because this was through December 31st, 2024. But this shows you the maximum drawdown in any particular year going back to 1980. Folks, what do you see? Minus 17, minus 18, minus 17, minus 13, minus 20, minus 34, minus 11, minus 19, minus 30, minus 17, minus 34, minus 28, minus 38, minus 49. These are not unusual occurrences. The question then becomes, are you set up properly to either weather the storm if you're going through the distribution phases, or to take advantage of these opportunities while you're in the accumulation phase? One of the things that I always tell my people when they're in the accumulation phase, the majority of your assets should be working for you. But for those of you who want to take advantage of the opportunities, you might want to keep 10% as dry powder sitting on the sidelines so that you have an opportunity to take advantage of these kinds of dislocation. What do I mean with regards to dislocation? I'll give you a perfectly good example. There's a company out there called Broadcom. They produce a lot of different things in the technology sector. Well, recently they were a $230 stock, per share stock. They got all the way down into the 140s when we had that serious pullback just 2 weeks ago. If you had picked those shares up at that particular time, let's say you bought it up at 145, today it closed at 196. That's a tremendous move in a short period of time. But if you were somebody that was doing your research and paying attention, and looked at it and said, wow, that's a company that I'd like to own, had a very serious pullback. Are the financials and is their business still as strong as it was in the past? Well, maybe it is, maybe it's not. Maybe they'll have to weather the storm just like everybody else. But one of the key elements that we always pay attention to, and one of the things that Warren Buffett, who's probably one of the most famous investors that most people have heard of, as well as John Templeton. John Templeton has since passed away. Both of them would have said to you, become greedy when others are fearful, and become fearful when others are very greedy. Right now, what are we seeing? People are very fearful. Well, many money managers, especially those that have been doing this for a long period of time, they're becoming very what? Greedy. They've been picking things up over the last week and change. They're not investing all their dry powder, but they're picking things up as they see some of these opportunities at some very, very cheap prices. This particular slide that we're looking at talks about asset allocation. What's the most important thing that you can take from this? As you can see, market timing is not the big element. It only produces about 2% of the overall returns. But 90+% comes from the asset allocation, how you've got your assets allocated. So it does two things. It improves diversification for you, but it also helps to do what? Act a little bit like a shock absorber for your portfolio so that you don't get as much of a downdraft by having broad diversification. Some assets will perform well, some will not perform well. But this is the advantages of having a well-diversified portfolio so that those shock absorbers allow that ride to be a lot smoother. So let's talk about, I love this, let's examine a few of the facts. Well, as I said before, I divide money management into two distinct categories, accumulation planning and distribution planning. So let's talk about accumulation planning first and foremost. So one of the most sound and simple game plans that you can use is dollar cost averaging. Why? Because if you decide to designate a specific amount that you're going to invest each month, if the market's up, what happens? You buy less shares. If the market's down, what happens? You buy more shares. Over time, by doing that, we lower our average cost per share, and thus that gives us a greater opportunity to have a positive return over time. So here's a quick example of exactly how it works. And you can see we're investing the same amount of dollars each month. And as you can see from this particular example, April, we invested $100. It was whatever we were purchasing was $10 a share. So we purchased 10 shares. The next month, it went up to $15 a share. So we're investing the same amount of $100, but we only purchased 6.7 shares. Following month, price dropped down to 13. And again, we bought 7.7 shares. As we move further along, what did we find out? If we divided the total amount that we had spent, the $300, by the total number of shares that we had purchased, what did we find? Well, our average cost per share wound up being $12.32 a share. And our average price per share now winds up being an average of 12.67. So we have a slight gain as a result of doing dollar cost averaging. It's a simple thing you can do. And for most of you, if you're participating in your 401ks, your 403bs, things like that, and you're doing salary deferral on an ongoing basis, you're already doing dollar cost averaging. One of the other things that I want you to always pay attention to is what types of investments are you purchasing? So are you buying, for example, the S&P 500, or are you buying other particular indexes to broaden your diversification? So are you buying some of the NASDAQ? Are you buying some of the EFA, which is some of the international markets? Or are you buying some of the bond market, like the AG? So there's lots of different things that you can invest in. Now, when you go to measure the performance of your particular instruments, what are you going to measure them against? You're going to measure them against a component called beta. What is the measurement for that particular sector of the market against the investments that you're choosing? So let me give you an example. Let's say that you decided to buy Verizon. Well, Verizon is an S&P 500 company. Question for you would be, how is my investment doing against the overall index or what we call beta. So the S&P 500 would be the beta, or the measurement that we're going to measure our particular investment against. So we're going to look at it from a couple of standpoints. The most common one that people are going to look at is standard deviation. So how much does my investment and its volatility, how does it measure up against the index? So let's say I had an index where I've got an investment vehicle and it has a beta of 1 compared to its index of the S&P 500. That means if the S&P 500 goes up 1, my investment goes up 1. So they're basically correlated 1 to 1. If I, on the other hand, have an investment vehicle that's much more aggressive, so I have a beta of 2 to 1. So my investment will go up 2 for every point that the S&P 500 went up. Same thing on the downside. So I would get down 2 for every 1 point that the S&P 500 went down. So you can either take beta and have more risk with your individual investments, the same type of risk if you're just buying the index, or less if you decide to buy investment vehicles which historically are less volatile than the index as a whole. Why would we do that? Some people don't want that super duper roller coaster ride. The other thing that people have to make a decision about is, do they want to be a passive investor or do they want to be an active investor? For the vast majority of people, where do you think I would position them? Passive. Why? Most people don't pay attention to what's going on in the marketplace. So if you've invested in vehicles that really would demand a bit more close watching with your eyes, you probably shouldn't be in active components, because by the time that you realize that things have changed, you may have missed the entire boat. So passive essentially buys the market. You're not trying to outperform by doing essential research and things like that. Active, typically we're looking to do what? We're either looking to reduce the risk in the portfolio, or we may be looking to outperform the indexes, or maybe a combination of the two. And then we may incorporate some additional elements like technical analysis and fundamental analysis into our decision-making process to help us select the individual components that we want in that particular portfolio. So as you can see, investing is not as simplistic as most people would like to think of it. You can make it very simple if you wish to do so by simply buying the market. So for example, you could buy the S&P 500 as an ETF or an open-ended mutual fund. You can do the same thing with the NASDAQ, and you can do the same thing with international indexes, and the same thing with the bond indexes as well. And you can do all of this through either open-ended mutual funds or through ETFs, exchange-traded funds. So let's talk about the foundational differences between technical analysis and fundamental analysis. Technical analysis really depends much more upon supply and demand and what we call the market itself and its movements. So most people who look at technical analysis are not overly concerned about the fundamentals. They'll tell you that the market's either overbought or underbought relative to that particular time frame and certain individual variables that they look at. And we call this technical analysis. They're going to do a lot more timing oriented component. They'll also look at trends. Is the market in an uptrend or is the market in a downtrend? So these may be considered what we call momentum investments. Okay, and as I said before, they're much more oriented towards what the pure market is telling them, and they really don't want to pay a whole lot of attention to the overall economic components. Whereas fundamental analysis goes exactly the opposite. Now we're depending much more on pure economic data. So productivity, profitability, earning potential of not only the company today, but potentially into the future because of new products and things along those lines. So some of you may be very comfortable doing just fundamental. Some of you may be very comfortable doing technical. Some of you may wish to do a combination of the two. The more that you incorporate into these two types, though, the more time you're going to spend to learn the specifics of how each of these components work. So what do we want to do in a decline? Well, I always like to start out by specifically looking at each of the investments and asking myself a very simple question. how have they performed compared to their peers? Are their peers all having trouble, or is it just this particular individual company? Also, you may want to selectively sell out some of your losers along the way. Why? Because if you remember, part of this game is taxes. So there may be times that you like a particular individual holding. You'd like to keep holding it, but it's got a loss right now and it's come under pressure. So you may decide that you'd like to sell that particular component out, recognize the loss. You can't move back into it in a non-qualified portfolio and take advantage of the tax loss unless you do so after 30 days. That's what we call the 30-day wash rule. So there are times, for example, let's say you wanted to continue to stay in the software, in the soft drink business, you own Coca-Cola, you have a loss, and you say, well, I'd like to continue to at least stay invested in that sector. Why don't I sell out Coca-Cola and I'll buy Pepsi in the near term? So now I've capitalized by taking advantage of that loss for taxation purposes, and I've rebalanced into a similar type of a stock as long as you feel comfortable with that. And that's one of the key elements that I tell people to do also. If as you're moving along, and some people really don't reallocate their portfolios, but I tell almost everyone, especially my clients, we're required to sit there at the end of a year and rebalance those portfolios. We want to make sure that they come back into the balances that we agreed is appropriate relative to the risk parameters that we've established. So it's very important for you to monitor those components. Some of you may do your allocations once every quarter. Some of you may do it once every 6 months, and some of you may do it once a year, but stay with the consistent approach to it because it's something that's important to do so that you don't get overly weighted in particular sectors that you did not want to do. And then the last thing is you have to monitor economic news for any fundamental changes that are occurring in the marketplace. Why? Because they have a dramatic impact on your company's ability to achieve their objectives, pro or con. So it's very important for you to pay attention. Doesn't automatically mean that you're going to have to make decisions about it, but you need to be aware of it and what's going on and how it impacts the investments that you have. What are some of the don'ts? Well, I'd prefer that you don't panic, but I know that for many of you, when you go through difficult periods of time, it's hard. It's hard to stay focused on the things that are the objectives that you have. Because now all of a sudden, for example, you may see your portfolio is down as much as a third or maybe more. Very difficult to stay calm and stay focused on the things that you're supposed to do. Sometimes you'll see the markets bounce back and you'll see tremendous up days after big down days. Well, if you need to rebalance your portfolio, that might be a wonderful time to do what we call sell into strength as opposed to weakness and rebalance your portfolio. I also tell people, even when you get these dramatic pullbacks, you don't want to be dumping everything in. You don't know where the bottom of the market is. So I typically tell people if we're going to stage into markets like this, try to stage in 3 purchases. My first philosophy for me is if we're down 10% in the marketplace, what do I look at and see that's appealing? Are they things that I would like to add to the portfolio or not? Once I see the market down 20%, I do the same thing. And once I see the market down 30%, I do the same thing. Why have I chosen those numbers? Because it's rare that we get into the 30% plus, but usually if we're getting down there, there's usually some wonderful things that become very, very appealing. And sometimes you just have to hold your nose, as I like to say, put your boots on, and you have to wade in and buy things, even though you're a little bit uncomfortable, because the market right at that particular time doesn't like that particular stock and doesn't like anything that's going on in many instances. So that's where your disciplines really come into play. So now that you've done the basics, some thoughts when you get into volatile markets. First, what's causing the volatility, and is it material to your situation? Or is it something that has nothing to do with you? For example, the president decided that he was going to institute all these tariffs. Is there anything you can do about it? Not a thing. If you were concerned about the impacts of that potential situation, in other words, a fairly significant downdraft, you should have considered that before your portfolio got to the point where we saw the downdraft so that you knew what you were going to do one way or the other. With interest rates rising, is this good or bad for you based upon your time horizon? Well, we're not seeing interest rates rise so much right now, but we certainly did over the last year and a half. And that could have a dramatic impact on the type of investments that you're purchasing as well as the time horizon. Do you review your situation annually to set up a game plan for the year? I would virtually guarantee you that the vast majority of you spend more time planning your vacation than you do your finances. Are you the only one that's depending on your portfolio, or is someone else depending upon it for cash flow? If the market goes against you, will you be able to survive it? And if you will be able to survive it, what will you do? Why do I ask this question? Because I've had people go into down markets. I remember in 2000, a client who had worked for one of the baby bells, and when he saw the market get down in the year 2000, almost, or 2001, almost 40% from where he started, he said, I can't take it anymore. And he climbed out. I said, this is the worst time to get out. He said, I don't care. I just can't take it anymore. When did he want to climb back in? When the market rebounded 40%. Had he not climbed out, he would have rebounded the 40%. Instead, at that point, he decides to climb back in after having lost the 40% from before. So please make decisions with your head and not your heart. What changes would you make, and are they planned out, or are they spur of the moment? Please have an idea what you're going to do when you get into these periods of time. It's not the time to all of a sudden go, well, now I think I ought to make a change. The market's down 25%. You should have had that discussion long before that market got down 25%. And lastly, do you have the financial knowledge and experience to determine the correct allocations for your portfolio in retirement? The vast majority of instances when I sit down with people and we plan for retirement, and I tell clients that come in, I don't take on new ones anymore. When I was taking on new clients, I would tell people, look, I'm a transition specialist. My job is to transition you from work into retirement and then ultimately to pass your assets on to the heirs in the best and most tax efficient way that we can. If you don't know what you're doing in this area, please get help. Why? If you make mistakes, they're going to be awfully costly. I can promise you that. So please don't be penny wise and pound foolish. Some additional thoughts for those of you who are new to this. Are you someone that establishes a game plan and sticks to it? If you're not, get somebody to help you to develop that game plan. Are you someone who is more of a passive or an active investor? Do you like to stay actively involved in this? Or is it something that you go, no, I don't want to touch this with a 10-foot pole? I have a number of clients who they're happy to have our annual review, and I'll tell them the pros and cons. And outside of that, they really don't want to be bothered with it. They'd rather live the rest of their life and not have to pay attention to it. An annual review keeps you focused on your goals. What does it also allow you to do? Watch out for the noise. There's so much noise in the marketplace today. I don't know how most people could make a determination of whether they should be in, out, make a decision to change one way or the other, unless you know what you're looking for and what you're trying to ascertain from the information that's coming across your desk or across, whatever it is that you're looking at, your iPad, your tablet, your laptop, whatever it may be. If you don't know what you're looking for, there's an awful lot of noise. Are you the only one depending on the portfolio, as I said before? Have you put investments into your portfolio that you understand? Or did you buy things that somebody said, hey, you ought to buy this? Why? Well, I think it's great of it. And you haven't done any homework. Warren Buffett used to say, somebody would say, did you buy X, Y, and Z? And he'd go, no. And they'd be like, why not? He goes, well, I don't understand what they do. So if I don't understand what they do, I'm not going to buy it. And then lastly, do you need a professional's help who's knowledgeable and experienced to determine the correct allocations and distribution strategies for you? That's your choice to make. But if you're not familiar with what you're doing, please grab somebody. And this is just some final thoughts. Markets will always be in a state of flux. They'll go up and they will go down. Question is, are you in accumulation mode or distribution mode? If you're in distribution mode, you must have a game plan for when markets go down. If not, you're too late. Why? There were two elements I talked to earlier about. First one is sequence of returns. The second one is the high risk corridor. What do I mean by each? A negative sequence of returns can destroy the integrity of your retirement plan. Let me give you an example. In the year 2000, everybody was concerned about the Y2K issues and that all the computers were going to stop working. 2000, 2001, 2002 all had market downturns. What was the aggregate amount? About a 50% move to the downside. So let's say you had $1 million portfolio, and I'm going to just use round numbers so that you can kind of get a simple understanding. If I had $1 million and I was depending upon it for 7% income, if the market goes down 20%, my $1 million portfolio now was reduced to 800,000. But I took out 70,000 because I needed a 7% income out of it. So now it's worth how much? 730,000. The market the next year is down 10%. So my 730 goes down by how much? Another 73,000. Okay, so how much is my portfolio worth? Let's just use round numbers. Now all of a sudden I'm at 660,000. But I had to take out that 7% income. So that's another 70,000. Now I'm down to 590,000. Following year, we have another 10% loss. So my 590 drops another 60,000. Now I'm at 530, but I had to take out that 70,000. Now I'm at 460,000. So in 3 years, I went from $1 million portfolio to a $430,000 portfolio. How are you feeling about your portfolio? Not very confident, are you? You have to think about these potential implications beforehand. If you wait until you're in the middle, it's too late. So if you're not thinking about these things, please get together with a financial advisor that can assist you, or even a family friend that can help you to understand the significance of sequence of return risk. A high risk corridor just adds more risk because the earlier you are that you retire without a pension plan and have to live off of a 403B, 401K, 457, what we call defined contribution plans, the more you add inherent risk for sequence of returns being adverse in your situation. Why? You got a longer period of retirement. So very important to pay attention to these things. Single most important element when planning for retirement is risk management. How will you manage risk in your portfolio during retirement? Because for most of you, if you're concerned about what's happening in the marketplace today, it's that volatility that's driving you to say, wow, am I okay? Am I going to be able to make it? And as I said earlier on, build your game plans based on the movie, the good, the bad, and the ugly. Now, somebody asked me a couple questions, and I'm going to pop over here. So let's see. Somebody asked me, what would be some recommendations to buy physical metals, example, gold or silver? If you want to buy the individual components, you certainly can go ahead and do so. There's everybody and their brother advertising, especially when you get periods of time like this. The only thing that I look at from an investment standpoint is a component called Sprott because it's actually backed by physical gold. Many of the other gold components, especially ETFs and things like that, are synthetic elements, not backed by the actual material themselves. So if you're going to get into that, you need to pay attention as to whether or not that's something that you want to be buying. This is an economic moment we've never seen before. President is starting a trade war with not just China, but also EU and Canada. Do we have a recession on the horizon? Quite possibly, but a down economy could lead to a lot of opportunities. Can you provide some specific guidance? I want to know what my game plan is. Well, if your game plan is not been established by now, you're a little late to the game, in all candor. Whether or not we have a trade war, I don't know. I don't know what ultimately will come out of this. If anybody can determine what Donald Trump's going to do from 1 minute to the next, you're a better analyst than I am. I have no idea what that man's going to do one way or the other. What I do know is his positioning relative to tariffs and why he has the beliefs that he has. You have to understand, Donald Trump was not a politician for many years. He was what? A businessman. He was a global businessman that did real estate in many, many different countries. So he's very, very familiar with all of the different barriers that were put up in front of him to be able to do business in these different countries. He's very familiar with it, very familiar with it. And quite frankly, if we as Americans, and I wish this is something that our federal government had done, had explained why we put tariffs on other countries, then we'd probably have a deeper understanding of exactly what's going on. But the problem is that virtually every one of these other countries has a tariff on our goods or has barriers to entry for us to be able to sell our goods in their countries. Now, us being the United States and who we have been for years and years, we're a magnanimous country. We want to see everybody do well. So what we've done through the years is we've provided the opportunity for many of these countries that were third world and second world countries to get into components like the World Trade Organization, which is exactly what happened in 1996 when President Clinton asked for most favored nation status in the World Trade Organization for China. That meant we were going to give them some tremendous advantages. Well, they never gave those advantages back. And so if you look at what has been transpiring, we have basically a tremendous trade deficit with China, where we're buying lots and lots of their goods, and yet they've restricted us in terms of the types of goods that we can sell in their country. They've stolen our intellectual property, and there's a multitude of other elements. And so when we talk about China, that's why we're seeing so much difficulty with trying to get an agreement between us and China, because China doesn't want to give anything back. The problem for China is that they're a pure export economy, and unfortunately, if they don't get an agreement sometime in the near term, they will see a depression. It's just a question of time. Do you recommend paying off any debt before the recession hits? Absolutely. I have recommended to anyone the ability to pay down debt today is one of the most important things that you can do. Why? Let's go back to 2008. Once the 2008 financial crisis hit, what happened to the Federal Reserve Bank and interest rates the following year? They cut interest rates to an artificially low amount. How do I know? I happened to refinance my mortgage at the time. I decided to go to a 15-year at 2.5%. I never thought I would see 2.5%. My first home mortgage was 9.75%. 2.5%, I was jumping for joy. What's the problem? It was an artificially low interest rate, and unfortunately, it continued for over a decade. What's the bad? Well, everyone got accustomed to interest rates being extremely low. In fact, I remember being offered credit cards during that period of time with single-digit interest rates. Get a Visa, 7.9. Get a MasterCard, 8.9. Those same cards today, with the same credit rating, actually I have a better credit rating now than I had back then, my credit rating, even today, will not allow me to see those numbers at all. The best credit card rate that I have now, which is one of my oldest credit cards, is all the way back up to 18.9%. So, do I believe that it's a good idea to pay down any debts you have? Absolutely. That will be the strangulation of the youth in this country, because the vast majority of them live what? What do they live on? Credit. And their ATM cards. Let's see. Do you believe someone could be late to the game if they don't have a plan? The market is cyclical. Have to start somewhere in regards to diversification planning. How should we diversify? Well, if you're late to the game, the question becomes, what is the objective? Because the worst thing is, for example, and I'll use a baseball analogy, you're 3 runs down, you've got an out, and it's the bottom of the ninth. Is everybody who comes up to the plate going to try and swing for the fences and knock a home run? Well, if they're not a home run hitter, that's not a good choice. So if you're chasing things when you shouldn't be chasing them, it won't work out well for you. But what you may want to do is start to look at what are the things, for example, that are missing in your portfolio. And especially if you need growth, what types of vehicles can you put into your portfolio for the future that will give you an opportunity to participate not only with the market, but potentially be out in the areas where the market will outperform compared to the rest of it. That may mean that you take and spend a little time doing research. On the other side of the coin, I don't know the specifics of your situation, so I don't know what you have and what you don't have, and I don't know what your risk-taking capabilities are. If you don't have much to work with, you may say, wow, I just don't have the capacity to take on that kind of risk. So it's important, if you're not familiar with how to get started in that area, reach out to somebody. And as I've always told people, whenever I do these events, my email's on it. I have always offered the opportunity to anybody that has questions, email me, ask the questions. I don't take on new clients. I tell people that right up front, but I'll be more than happy to guide you in the right directions to hopefully help you get on the right game plan, right track. Let's see if we have any other questions. Just one second. I think that's it. I will, at this point, hold on, let me just pop to the last page. So I want to thank all of you for tuning in this evening. There's my email down the bottom. It's mark.lange@lpl.com. If you have any other questions, please feel free, pop a message in. Let's see. Hold on, I got a couple more. Pay your bills down, need to have liquidity, increase your savings. Yep. Do you believe some? Okay, let's see. I always offer my time. I candidly tell people, especially when I do these events, I have been incredibly blessed. I have had a wonderful group of clients that I've had for many, many years. Most of my clients I've had for over 30 years. And I've been very blessed. But this is the way that I give back. So I teach for SOFA, I teach for My Secure Advantage, which is a corporate element. And anytime that I can give something back to the local libraries, and especially to my constituents in the area, I'm more than happy to do that. So as I say, if any of you have any questions or you think that there's something you'd like to explore in greater depth, feel free, send me an email. I'll be happy to reach out to you and have a chat with you and hopefully be able to help you move you in the right direction. I don't see any other questions. Yeah, I don't see any other questions. So I will say thank you very much for coming in and joining me this evening. And I will wish you all safe travels if you're traveling someplace. Otherwise, hopefully back to your dinner table.
Yes, and thank you so much, Mark, for giving us your time tonight, and thank you so much for everybody who participated tonight. If you want just to quickly take a screenshot of his email, go for it. I believe probably towards the end of the week we should have the presentation up on our YouTube channel. So if you miss it today, at the end of the week, we'll have his contact information ready.
Super. Thank you so much. Good night.
All right, have a great night.